I'm Mark Gagan and you're listening to the Voice of Insurance podcast, produced in association with Advantage Go. Pick and choose your own best-of-breed insurtech and data providers with Advantage Go's ecosystem. Today's guest has one of the broadest international reinsurance roles of anyone I've interviewed on the podcast. That's because Louise Rose has oversight over everything that TransRe does outside of the Americas. Louise has been on the show before as part of the annual Monte Carlo special episode, but it's wonderful to have the time for a comprehensive examination of the state of the reinsurance world. And that's exactly what you get today. We cover everything from the trajectory of the market to TransRe's strategy as it looks to gain a stronger foothold in Continental Europe and the Asia-Pacific region. AI, cyber, MGAs and the state of the casualty market all get a thorough workover. Louise is in her 29th year at TransRe and is always direct in her communication style. It's refreshing and makes for a highly informative and valuable encounter. Enjoy the podcast. Louise, welcome to the Voice of Insurance.
Thank you very much.
For anyone out there who doesn't already know you, why don't you just briefly introduce yourself to the audience and run us a bit through how you got into insurance in your career to date and how you got to where you are now?
Sure. Well, I think like most of your listeners, Mark, I stumbled into this business. It was probably quite a lucky stumble, I think, with hindsight. I was a bit of a latecomer as well. I studied for 4 years in Italy and stayed on in Italy for a few years afterwards.
And what were you studying?
I was studying European Business Studies and I worked as an interpreter, freelance, for about 3 years after graduating. So I actually didn't really come back to the UK until I was about 25. So I'm sort of a little over 31 years in the business and I have been lucky enough to spend 28 years of those with TransRe.
So your Italian must be pretty good.
It's pretty good. It's not quite as good as it was all those years ago, but I holiday there quite frequently and it certainly does come back. So so that's good. So basically I've come up through the underwriting channel. Short tail treaty is really my background, although I did start out very originally doing engineering facultative. So I've done property, engineering, aviation, A&H. And about 7 years ago in 2018, I became deputy CEO for the London subsidiary here and succeeded my old boss, Jeff Peach, in 2019, just before COVID. Timing is everything. And then earlier this year, my role was expanded and took on the wider international brief. So I now look after all of the business units outside of the Americas.
So it's pretty much rest of world, effectively, isn't it?
Yes, pretty much. Anything outside of the Americas falls under me and my...
That's amazing. So you must be really accumulating lots of air miles.
I certainly am, yes. And I'm figuring out how to manage jet lag.
So, President of International, you run TransRe's London, Europe and Asia, as in effectively rest of world, that's not Americas. Give us a sense of the scale of that business. How many offices, how many people?
Yeah, absolutely. I mean, look, when I joined 28 years ago, we had about 35 people in London and wrote about $250 million. London's now over 100 people and the wider international region, including APAC and Europe. We have 10 offices spread across the region, headquartered here in London. 3 underwriting outlets in Continental Europe and 5 in APAC. We're big believers in local representation, local people with local knowledge, understanding the culture, local language, and really writing the business as close to source as we can.
I always think about when it was transatlantic re back in the early days, but you always hear you've been in London for a very, very long time.
Yeah, we actually missed our 40th anniversary. That was in COVID. So I guess we'll have to do something for 45. But yeah, 1982, I think we started out here. Actually, the very first overseas office for TransRe was actually in Tokyo. I think I'm right in saying that we were the first overseas registered reinsurer in the Japanese market and we're still there.
I suppose, is that something to do with the old AIG connection?
But very possibly, yes. I mean, I think, many of your listeners will know we were born out of an internal sort of AIG vehicle.
But it was a very, very long time ago.
Very, very long time ago. Yeah.
So when you're looking across the world, what's your strategy? I mean, do you have an overarching strategy? Do you have to have different strategies for different areas?
I think you do have to have different strategies. I mean, look, as I said, we're very, very keen on writing the business closest to source. I think as I spend more time in our regions, particularly APAC, I'm beginning to realise there's quite a lot of product differentiation. It's not just P&C. If I think about our London portfolio, we have about a third is property, some form of casualty, including motor, and some form of specialty. Now, it's not a hard and fast strategy to have that split anywhere else, but it's just really to sort of challenge ourselves around product to make sure that we recognise local nuance in product. And I think what's very important, though, as well, is that we export all of the knowledge that we've built up in the organisation across all the different regions and make sure that we really get that know-how, that knowledge, that expertise to our clients wherever they are.
And in terms of that strategy, sometimes the only disadvantage of writing things locally is, do you end up with a higher expense base, or do you have to make sure, be very careful before you open an office to think we're definitely going to get the volume of business that we really need to support that infrastructure?
Yeah, I mean, look, we operate pretty lean and mean. I'm sure all of our staff would tell you that if you ask them. And, there's economies of scale. We don't have every single product line represented in every single office, but TransRe writes pretty much all major non-life lines somewhere in the group. So our challenge, and I think we've got a lot better at it in recent years, is, as I say, to make sure that we export that knowledge, that we support the local teams so that they can develop the broadest spread of business supported from the two larger hubs, which are New York and London.
And when you're out there in the marketplace, what's that sort of brand awareness you're trying to create? What do you want that broker or that cedant to think of when they think of TransRe? Oh, I know they're really specialists in this thing, or actually they're really good across-the-board partner, that they're really handy because they could probably write a whole bouquet of everything that I do, and we'll have that kind of relationship. What sort of image do you want to project?
Yeah, I think it's a really good question because I think it's evolving. We were born as specialists, really. We started out and still have an extremely strong casualty franchise, particularly in North America. But that isn't all that we do at all. And as I said, particularly here in London, we're a third. Specialty plays a big part. So I don't think the two things are mutually exclusive. I think our clients are adapting and evolving how they buy reinsurance. If I think about when I first came into the industry, they were all buying a lot of regional covers. Even the largest global buyers had quite regional strategies. That has changed.
So you end up with sort of, you could be writing something, I don't know.
Exactly. We probably
Allianz,
had 6 or 7 cat programs for, one of the large buyers. And that has changed a lot. And there is definitely a shift. We sense that shift towards sort of a more holistic approach. But we think you can be both. What I notice when I'm traveling around is not everybody wants to be treated the same. Not everybody wants you to approach them in the same way. So I think the most important thing is to listen, actually, to what your clients are telling you and work together. Communication is key here. Every single one of our clients is a partner, but they want us to partner with them in different ways. And we just need to spend time to understand what that looks like for them and find mutually successful ways to do that. And I think we're making great strides in that.
So it sounds like you don't necessarily want to be specifically a generalist with a deep relationships of philosophy, or neither a specialist, but you want to be whatever the client actually wants you to be.
Well, I think it's about bringing your specialist knowledge to the relationship that the client wants to have with you. And that's why I say I don't think the two are mutually exclusive. I don't think one is right and one is wrong. The absolute key, I think, is communication, transparency, and openness. We'll have clients that come to us and say, look, this is not a core purchase for us, but we'd really appreciate your support. We're fine with that. We can work with that. Where disappointment comes in is when both sides actually pivot on strategy without necessarily a good lead-in time and a communication. And that's something that we always try to avoid.
It's interesting you were saying about that consolidation certainly at the higher end of the insurance. The top 10 global insurers, for example, whereas 30 years ago, they probably would have had, I don't know, goodness knows, an almost innumerable number of regionalized treaties in different lines. They probably had 400 or 500 contracts. And of course, somebody at head office said, look, actually, there's got to be a better way of doing this.
Yeah.
And, they would centralize them onto their sort of own in-house reinsurer, for example, and then they buy a massive retro out of the top. And I suppose as a reinsurer, he said, well, this is fantastic. It's more efficient for me as well. It saves me having to deal with so many different bits of paper, and also it's an incredibly diversified contract. This is a very solid right, but it's only it's gone down from 450 contracts down to about 5 or whatever it is. So I probably only need one office to write that, but you've still got that regionalized office structure. Is that because obviously the global top 10s of the future are probably going to come out of some regional?
Well, yeah. And I think what I'm realizing the more I travel is that there's a lot of product differentiation. Different markets, and I'm probably thinking more about APAC here. There's very different markets in APAC. There's some very mature, established markets like Japan and Australia. And there are markets which you would describe as more emerging.
So there's almost more life and credit and all sorts of things.
Exactly, A&H, but also a very different structure to the insurance. There's been less M&A. We've seen in the more established markets, US, Europe, a huge amount of M&A. So you end up with these mega buyers, as it were, huge amounts of consolidation. You haven't necessarily seen that to the same degree in some of these emerging markets. So things like solvency covers, different product types. But again, it's very difficult to do that from remote regional hubs or to do it successfully, because you really need to understand the client, spend time with the client, understand the motivation for purchase and the claims environment and the legal environment. So all of these things, I think, even with global clients, they're putting all of their business globally into a lot of these protections. But that business is not homogenous. It's not uniform. There's a huge difference between the US casualty environment, the legal framework, versus other parts of the world. So those local insights that we can build to get to know our client's regional business better, it might be protected in a global treaty, but it doesn't mean to say that there isn't significant variation and nuance in the underlying portfolio. And that's really important to understand.
And sometimes, of course, the local regulator quite rightly wants to see that that business is being properly priced as it's seeded, that they're not sort of sucking out capital or sucking out profits out of that jurisdiction, for example, without paying the right levels of tax and all the other things, for example. So again, often it seems that the global reinsurer, that global office is still valued, isn't it? Because it's almost providing the price for that session that's going to go up, and it might end up in head office anyway. But so you'd still need that local validation, don't you?
Yeah, I mean, look, different companies have to have different models. We just remain very committed to having a regional presence and really understanding local markets and local culture and local nuance, and being able to support, whether it's a small regional local client or a large global's regional business. We just do believe that the outcomes will be better if you have a broader understanding of the portfolios that you're protecting. And
you pick some nice partners and they grow fast and you grow with them, and you help each other.
Absolutely. And this comes back to the question earlier around, do you want to be a specialist or seen as a more holistic supporter? You can be both, and different clients need different things from you at different times. A startup or a business that's maybe in the throes of an acquisition or a sale has different reinsurance needs and probably can't predict quite what their reinsurance buying is going to look like in the next few years. And they want one approach. And then you have books which are more stable. I mean, everybody's portfolios are evolving all the time, obviously, but probably in terms of product mix, and it's more stable, and you can look at those clients in a slightly different way. So it's really horses for courses. The key is, as I say, I think it's to listen and understand the motivation for purchase. I think that's one of the first questions that we tell our underwriters they should be asking of their cedents and their broker partners.
And I suppose there's also that fact that, of course, all those cedents, their security committees, they'd all love to just do one contract and go home. But at the same time, of course, they need to have diversified reinsurance relationships.
Yeah, absolutely. And it can be a little bit cyclical. We've seen periods of consolidation of panels, and then the thinking will shift to more diversified panels. Again, we're obviously one of the strongest rated balance sheets out there. So hopefully in everybody's thoughts and plans.
So this is nice security to have. This is going to probably enhance the overall security of my program rather than detract from it.
Exactly.
Let's talk about the market. Well, the markets. I mean, there's so many. This is the whole world.
Yeah.
It's difficult to describe, I'm sure, because temperature is very different in different places at different times in different classes, different territories. But just generally, how would you describe the state of the reinsurance market at the world, the global reinsurance market at the moment?
I would describe it as transitioning. I think there is clearly pressure in the vast majority of lines, and we'll come on, I'm sure, to talk about US casualty shortly. And look, everyone can do the maths. I think we've come through original pricing and obviously reinsurance pricing, a strong period of rate improvement, not just rate, structures, terms and conditions. So for many lines of business, you're coming off, maybe a decade high rating environment. So it is fair to say that pricing can tolerate some degree of softening. What I think our industry has historically been terrible at is spotting the tipping point. And I think that's always a difficult part.
To know where you're actually pushing quickly gone into inadequacy.
Yeah. Good news on the upturn takes time to manifest. And that's the same with bad news on the downturn. And I think there's a really good example of that right now in the US professional space, professional liability. It obviously went through a period of significant hardening in the sort of 21, 22 years, but it has been falling rapidly since then from sort of 23 onwards, consistently and at a fair rate of knots. But we won't see for some time the impact of that. Now, that might explain why it's continuing on its current trajectory. It might be slowing a little bit, but history would suggest that that line of business has passed the tipping point. And I think the danger right now for the market is not the pricing in 25 and probably not even the pricing in 26. But the danger is going to be a complacency around spotting that tipping point. Because as I say, the annual financial results lag on the upturn and the downturn. So we would say there is some opportunity out there. Rates are generally coming off peaks for sure. If I think about property, we had a horrific period from sort of 2017 through to 21. And then the last few years, property has been the cash cow, quite honestly. So inevitably, that leads to some softening, and we're beginning to see that. I think on the specialty lines, that's very interesting. It spans quite a broad range of lines, marine, aviation, some of the financial risk, terrorism, quite a broad spectrum there. And if you just look at the uncertainty in the world, whether that's pure geopolitics or whether that's uncertainty in the way some of the losses are going to manifest, and I'm thinking probably Russia, Ukraine on the leasing side there, there's a lot to play out. I'm not sure whether fear is the right description, but there's certainly uncertainty. And I think uncertainty usually should at least improve pricing economics. So whilst the general trajectory is negative, exception being obviously US general casualty, but there are, I think, reasons to see some pockets of stabilisation as well, possibly improvement.
I suppose the story of the reinsurance reset that we've had since 1/1/23, the last couple of years, obviously the price was great, it's been very, very good. And obviously that was also on the benefit of the underlying insurance pricing all improving at the same time.
Yeah.
And then reinsurance pricing improving. But even more importantly has been the attachment points, really resetting the attachment points to a much safer level. Again, is that coming under pressure? Because that would probably be the one thing. Certainly the story of last Monte Carlo, for example, I would say, sort of summarising, or the last 1/1 was that reinsurers were happier to trade price than they would the attachment point. They didn't want to go back down there again.
Yes. I think the great difficulty, and we sit with clients and brokers, we hear the arguments that cedents, and I talked before about having to listen to what your cedents need and want to buy, and I am a big believer in that. I think the big challenge in, let's call them working layers, the big challenge in working layers is you need reliable data. And I'm probably thinking more property cat here. I think the great challenge, we've been talking about it for several years now, is the increasing frequency and severity of loss. And I just don't think that, really the industry knows quite how to deal with that and how to price it. And that makes coming back down in terms of attachment point a challenge.
But we should be getting better, shouldn't we? And also we've got more data. There seems to be data coming out of our ears in terms of, everything's got a sensor attached to it. We've got mobile in. I mean, there should be so much more data. Do you think we're actually getting our heads around this?
Well, I think you touched on an interesting point, and again, we may come on to it later. I think there is more data. The question is, do we have the capability and the tools and the technology to really mine that data and to understand what that data is really telling us? And I think, the answer is probably not to the degree that is giving us not certainty. Insurance isn't about certainty. It's obviously about the unknown. But you have to feel you're on the right side of understanding.
You have to feel that your price is at least is greater than the burning cost.
Yeah. And you have to have a certain security in that pick. And I think that's proving difficult. And particularly with things like property cat, we judge these trends over decades, not 1 or 2 years. So, it's becoming more difficult. Obviously,
some insurers are better than others, some reinsurers are better than others. Do you think some really are getting a handle, and when they're coming up with their next renewal, they come up with a real thesis as to why you could get back into them nearer to the burn,
look, we'll look at these things, but we're told that others are, and that's great if they are, because this is a marketplace and markets need to provide solutions. I think one of the things that separates the more successful from the less successful companies in our business is those that can innovate and that can develop products and ideas and solutions.
I suppose you'll know it when you see it. When you see a submission that is streets ahead of anybody else's, and think these people really have thought about this problem, haven't they? That they've looked at the frequency and severity of property losses in their book, or wildfires or whatever it was, and they've shown you something very clearly that they've done that they would like you to give them some credit for. And then I suppose it's easier to give credit if they can put a beautiful case. I suppose then it's down to the individual company in negotiation.
I mean, look, every single client is priced. We price every single piece of business as if we're leading it, although obviously we don't lead everything. But we put that time and effort into every single piece of business. We say this to clients all the time. The better your data granularity, the more that you can give us, we will reflect that in our best view of the price. That's the commitment that we make all the time. And there is depending on the line of business, there's, often significant differences in quality of submissions between clients. That's sort of inevitable. So we always try and do our best to reflect that. But coming back to the attachment point, it is a challenge. We know clients and cedents would like to have more protection for that earnings volatility piece. We get that. But it's not sustainable. And I don't think it's actually helpful to the industry to be offering products that aren't supported by good analytics and where pricing over a cycle is going to be sustainable.
This is not the sort of classic, the broker comes in and says, well, you have to write this, otherwise you can't write the rest of it.
Oh, we've heard that. We've heard that many times.
The loss leader, you have to write the old loss leader because that's what the client wants. And then the rest, you can write the new top layer though as well. Thanks.
Exactly.
You have to look forward to these conversations as the nights get longer and the weather gets colder. One other thing, we've established that the market's a little bit softer than it was, more competitive than it was. What about demand side of things? Obviously, there are two different types of soft market. The worst one is where suddenly demand's full of cliff and so there's nothing coming in and you're wondering where the next submission's coming from. What sort of submission flow? Somewhere like London where you can measure it more easily.
Submission flow isn't our concern, particularly on facultative. We've actually been expanding our facultative teams globally. We now have Casualty.
And it's something you've been strong in for such a long time.
Absolutely. And look, facultative results outperform treaty results year in, year out. Absent a single large risk loss. But over time, your facultative results should, and ours do, as does most of the industry, outperform treaty. And that makes sense. You're selecting individual risks, you're pricing individual risks. But traditionally, we're a big casualty fac writer in the States, but not internationally. But we now are offering facultative casualty in London, both professional and GL. We've also expanded back into facultative in Continental Europe, but on the property side, and hired additional resource here in London. So big believers in fac. It's always been a very important part, but an important part of our portfolio.
So it sounds like the flows are very
healthy.
Deal
flow's healthy. London can never become complacent. I think in the past, there's been a little bit of a danger of that. I think a strong Lloyd's is really important for the London market. I think where London has an edge, which it could easily lose, but right now I think it does have a very deep talent pool. Its ability to offer pretty much, again, sort of every product line, very strong in specialty lines, does continue to draw business. But look, there's just no room for complacency. Regional hubs now, whether it's Dubai, Singapore, are very well established, and London has to fight hard for the right to see the business.
And do you think some of the technological advances, the things that are making submission flow more digital, with less friction, less costs attached? There's not a top 10 broker that doesn't have some kind of facilitization plan. And obviously the carrier side, there are also plenty of providers out there who want to sort of help facilitize some of the things you're doing, or the things that could be facilitized, the lower value, higher volume stuff. Are you encouraged by any of that as a way of London being able to compete or to be efficient?
I think, as you've just described facilities as a sort of an administrative efficiency and streamlining,
I know, but it's
fine.
But it does conflict with you being able to individually underwrite everything.
So I think facilities have had a bad name in recent years, probably some for good reason and others not. So I think there is a place for the streamlining and process efficiency. I guess my hope as an underwriter by trade and by background who wants to see every single risk, I guess I question whether the traditional facility will be necessary if we can really harness the full power of AI capability within process in our business. I personally feel a little bit too much of a downside around the facilitization of business, albeit I agree that from a process and an expense efficiency, they could and should have a place. But I think AI will deal with that in the future. Already is, quite frankly.
Because you'll still be able to individually underwrite it, almost everything, but you'll be able to do it so productively that you'll be able to, instead of writing 10 risks a day, you could write 100 or 1,000.
Exactly. I mean, I think AI, in the initial phase, it's going to be more of a process advantage, but you're limited only really by your own imagination, ultimately, in how AI will impact on our business.
I often have a thought that, of course, at some point in the future, we might not need treaties because the risk can just go through them so quickly. Someone will put down $1 billion line somewhere, but all the different bits that need to be reinsured will be reinsured facultatively, but instantly. Or that before they put the line down, it could have all been sort of pre-placed and pre-packed.
Yeah.
And then it just flows. And then you won't need a treaty anymore, because why would you want to have a minimum deposit premium and things?
That's a really interesting thought.
I
hope I'll be retired.
Way off in the future,
exactly.
though, isn't it? But I suppose you're doing two forms of automation. The first one, with the proportional treaty, is you've already pre-automated, said, yes, I will support you with 20% of everything you do. Whereas you're going to almost automate everything individually.
Yeah, I mean, look, treaty underwriting has always been about underwriting the underwriters. As you said, you're effectively setting a framework and accepting a basket of risk when you spend your time, obviously, understanding those portfolios and really underwriting the underwriters.
But let's talk about AI. From what you've just said, it sounds like you're seeing the first useful use cases for AI as being the sort of low-hanging fruit, getting rid of the boring stuff. Is that how you found it most useful so far?
Yeah, I mean, we have a dedicated AI team, the very originally named TransRe AI team, and they are initially focusing on process efficiencies and enhancements, and that could be around wordings reviews, obviously premium bookings.
Ingesting.
Yes, exactly. Taking data into systems. I mean, aside from time and cost savings, I think if you can improve the error rate, anything where you're manually keying in data, you're clearly going to have a higher rate of human error. So I think our focus, and I think a lot of the industry focus, is that as a kind of low-hanging fruit. Probably for me, the next phase would be, and we talked about it earlier when we talked about data, and there's more data available, but are we able to mine it and understand it and draw conclusions from it? And I think AI is going to be a game changer for that. Almost like the non-numerical assessment of data and mining.
Yes, those conclusions to be useful and things that will help you rather than conclusions that might not.
Yeah, absolutely. But, looking for things like, patterns in claims data, as I say, sort of non-numerical dissecting of information. And I mean, all of us are capturing more and more information. But as I say, we're certainly not harnessing the full power of AI yet to mine that data and to understand that data and draw the conclusions. And I think that's, again, the next sort of inevitable direction for
And do you think
AI.
we're anywhere near, obviously at the moment, we're sort of creating an indefatigable underwriting assistant. We'll ever get to the point where we're going to create an indefatigable underwriter?
We already have it really in the lead follow market, I guess.
See, we've got an automatic follow underwriter, haven't we, at Lloyd's?
You do, exactly. Yeah. So, you'd argue that it's partway there. I mean, look, all underwriters will blanch at that notion. But the fact is that the pace of change of technology, large language models, machine learning is so rapid. I think it would be foolish to rule anything out. However, I do think you need to have significant checks and balances around that, certainly initially, and there'll be
and let's face it, I mean,
period of
we're
overlap.
A highly regulated industry. At some point, the regulators are going to come and tell us what we can and what we can't do at some point.
Absolutely.
When they get around to it.
I learned a new expression this week, data lineage.
Oh, goodness.
And I used ChatGPT, actually, to figure out what the definition. I'm going to read it because I couldn't possibly
have
remembered it.
Like if you're buying an antique to prove that it was,
Well, it's a bit more than that. Let me read out what it says. So data lineage refers to the process of tracking and visualizing the flow of data from its origin through various transformations and processes until it reaches its final destination. It provides a detailed map of how data moves through an organization's systems, including where it comes from, how it is transformed, where it is stored. And I think this is the crucial bit. This is crucial for ensuring data quality, compliance and governance. And I think that's what we have to marry together.
Because at some point, the regulator said, well, why are you discriminating against all these people?
Yeah,
and you said, well,
absolutely.
I don't know why, actually, because that's just what the machine told me to do.
Absolutely. So I think the power for change and the pace of change can be extraordinary, but there has to be the checks and the balances and the compliance and the governance around that.
You have to look inside that black box and be able to say, I know why we did that.
Yes, absolutely.
Because otherwise, I suppose if you can't do that, then you probably suppose you shouldn't be running an insurance company.
Yeah, exactly. The governance or the compliance around what we do is significant, but it has led to an increase in the professionalism of the business. There's no doubt about that. So.
Well, let's talk about Casualty. Obviously, I don't think I could do a podcast with TransRe without talking about Casualty, given that level of expertise and the amount that class is associated with you.
Yeah.
How are you feeling? Obviously, we've been through a classic sort of pricing and reserving cycle of the last 4 years with some reserve strengthening and all sorts and lots of uncertainty. How do you feel? Let's think about business that's being written today that you're reinsuring today.
So it's quite interesting. If we sort of wound the clock back 5 years, we probably thought professional liability and general liability were in a similar place. We knew that the sort of 14 or expected the 14 to probably at the time 18, now maybe more like 19 and 20 years were going to be tough. As you said, there was evidence already of significant deterioration and both lines of business hardened significantly. And as you said, this is very much in our DNA, and we lent into that. If you fast forward to now, or even a couple of years ago, the outlook for those two lines of business, professional liability and general GL umbrella, are so completely different. We haven't seen the reserve deterioration on the professional side. Certainly the 21 to 23 years are looking exceptional. And that only means one thing in our industry, which is, as I said already, falling rates. We think they've fallen too far. We think
you called this in the report, didn't you?
Yes, absolutely. I mean, we write a number of reports. They're all available publicly.
I shall make a link.
Yes, that would be great. Thank you. Shout out to Elise McKenzie and Keith Trigg, who are GL and professional product leaders globally, and they put a huge amount of time and effort into those publications. So that's the outlook on professional liability. And then, of course, GL has gone completely the other way. I think we've just seen this, well, I don't know if it's unprecedented, but certainly the deterioration of the back years has been worse than anybody thought. And probably more concerning still is the 21, 22 years, which everybody thought at the time, at pricing levels at the time, were going to be maybe as good as the liability is looking. Well, that's certainly not the case. There's some worrying trends already in those years, not expecting them necessarily to mirror 14 to 19. But as a consequence of that, we are now seeing, and we have seen probably for the last 3 years or so, sustained double-digit compounded rate improvement. Now, the $1 million question is it enough? Have we got the reserving right? I mean, we've seen the press releases from numerous of our peers in recent quarters. So we probably have as much data as anybody on this. And we think the outcomes are going to be very different by client. We are maintaining a portfolio with those that we believe are navigating through keeping the limits compressed, keeping the rate.
It's always an amazing thing. I've probably spent most of the teens of this century interrogating the market and asking them, is rate adequate right now? And for most of those teens, people were quite happy.
Yeah.
And of course, it's only with hindsight that they weren't. And I mean, that's the $1 billion question, isn't it? If you could bottle up exactly what could I inoculate myself with during 13 to 18 when everyone else is slowly losing their minds, with hindsight, of course, at the time, it didn't seem so bad, did it? They seemed very benign at the time.
I think that's the whole point here, that the whole industry...
I'm not just talking to random people in the pub. I was talking to the smartest people.
Yeah, absolutely.
You know?
Absolutely. And the nuclear verdicts, thermonuclear verdicts, we even have that term now. So it's very difficult to be certain, but we do believe that our core partners are keeping rates in the right place. They're keeping limits compressed. They're managing as well they can.
And I suppose as a player in the market, I suppose you have to keep your relevance. You will have suffered just as much as everybody else in those more difficult years, but you have that relevance and you have that commitment to keep going, I suppose, and to learn.
Yeah, I mean, look, the back years are the back years. We shrank our book considerably in those years and then grew it, frankly, from 21 onwards.
Right thing.
We think we did the right thing. With hindsight, it would appear as if we started to grow too soon. But everybody believed at the time that 21 and 22 were going to look better than we believe they will do now.
Another thing that's been very interesting the last decade has been the growth in MGAs as a distribution channel. And again, a lot of people would say that that's perfectly understandable, that talented insurance underwriters would want to own more of their own equity in that underwriting skill. And that seems perfectly natural. And of course, a lot of technology is allowing that to happen, that they can run effectively sort of virtual insurance companies these days. And of course, they can have the latest tech, whereas their old legacy carriers have a lot of legacy tech. That's a thesis that makes a lot of sense. And of course, there's a lot of new, interesting specialty, innovative classes of business around at the same time. And obviously, when we talk about the last 15 years, obviously something like cyber, and the MGA seems to be a natural place to go and do some of that innovation. But then also, one of the other parts of that thesis is that also, of course, reinsurers, long-term reinsurers, have had less of that kind of business in the books that they were reinsuring from their traditional cedents. As some of that hiving up into global programs happened, you would get less of that sort of stuff. You'd be asked to take on more of the tail and less of that kind of what somebody used to describe as ballast business. This sort of nice, stable things that run at 99 forever type business. They don't set the world on fire, but they also don't cause you any embarrassment, and also are a core part of some of your profits there year after year. Is that the right way of describing what's happened? Is it just a secular change, a permanent change in the way things have gone? Because as reinsurers, you lost out on some of that kind of business, and now you're backing a lot of those MGAs, either, some of them through sort of fronting companies, that kind of thing. But do you think that's the right way of describing it?
So here's our view. The US MGA space has been very established, very successful in many ways for many years, often characterized by niche businesses with either niche product or niche distribution, which the large, often global, established, risk-bearing insurance companies wanted to take a piece of, and this was an efficient and effective way to do that. Some of those insurers partnered with reinsurance, and we were able to access some of that business as well, sometimes not. We have some very long-standing MGA and carrier partnerships in that space, and will do in the future. I think what we've seen in recent years is quite different to that. If we think about that original model, there was a lot of underwriting discipline and there was a lot of operational discipline from effectively the carriers, so the paper providers, the insurance companies.
Yeah.
That has shifted. Now, let me say, first of all, that there's always been a few fronting companies who operated a different model. It was a fee model, but they had an infrastructure and were providing a good service for that fee to reinsurers and to the MGAs. They were providing an operational infrastructure to support those MGAs, and particularly if they were startup MGAs. And again, no problem with that model. I think what has changed, and I'm not sure it's been driven, in our opinion, by traditional rated reinsurance carriers, but I think what we have seen in recent years is, I'll call it an explosion of MGAs and fronting companies with a very different sort of mandate. And any fronting company is always going to need reinsurance support by definition. They're not taking the bulk of the risk themselves. But I don't think that the more recent fronting companies are being supported largely, I'm not saying clearly there'll be exceptions to this, but they're not being largely supported by the same reinsurance panels that were supporting perhaps that first incarnation of the MGA and carrier market. And I think what you've seen is something that shifted from a sort of underwriting focus to a fee generation. And our concern, quite candidly, is where is the underwriting focus in that chain? Yeah. And we think that has been lost a little bit. Now, look, I don't want to sound as if we are anti-innovation or anti-change. I think the insurtechs, different model, different market, but the insurtechs have come in and frankly held our feet to the fire as an industry a little bit and shown us that there are different ways to do things. But at the core of insurance has to be underwriting integrity. And if you lose underwriting integrity from that chain, we don't think it's sustainable.
No, you can't just lose money year after year and
Absolutely,
keep growing because you just lose more.
But any insurance company can lose money. That's fine. We've said before, we're in the business of risk, reinsurance in particular. Our job is to take volatility away from insurance companies. But over time and across a cycle, you have to have a profitable business. And if underwriting discipline and integrity and oversight is not at the core of that chain somewhere, and it becomes about fee and about volume, then we don't think it's sustainable. Now, time will tell.
Yes, I suppose in the end, they will just run out of steam, won't they? Because they'll burn their capital.
Absolutely. I think the point, Mark, is it's not necessarily super long-term capital here. It's not the same as a rated balance sheet. It's not the same as a large insurer with all of that infrastructure and sort of underwriting DNA providing that paper. So, look, time will tell. We're not against innovation, but innovation in any form in insurance has to have at its core underwriting integrity.
So it's got more competitive. It's attracted an alternative set of investors who are probably more excited. But at the same time, it sounds like you don't think they could all succeed at the same time.
It's not for me to predict their outcomes.
Let's face it, not everyone succeeds.
That's the reality of it. And, you see that in any sort of business that evolves, any industry that evolves, and particularly often the forerunners, there will be casualties of war. And we think there will be in this current incarnation of the MGA market. But that is in no way criticism of that traditional MGA model. As I say, we've been long-term supporters of numerous facilities and will continue to be
because
so.
When everything works right, everyone's interests are aligned.
Absolutely.
Underwriters are happier than they would be in other situations, and happy people are going to do good jobs, aren't
they?
And
it's distribution. And, we all have to be thoughtful around how we access business and have different ways of thinking about it. But at its core, insurance is about underwriting, successful underwriting, to make it sustainable.
And also, if you're at the end of the chain and you're the one losing money,
you won't stay there for very long. Exactly.
But let's have a quick chat about cyber. It's been quite interesting. We've had the advent of an ILS market for cyber, a kind of cyber cat market, should we say.
Yeah.
Are you encouraged by that? That's a market I know that you get involved in.
It's interesting, the cyber market. I think AM Best published some numbers just this week, which showed that the US cyber premium has dropped for the first time ever, I think. So if we think about, is the cyber market maturing? I'm not sure that is necessarily the case. I mean, I think if you look at the relative limit available versus the potential exposure and demand for the product, I think there's still a very long way to go. I'm thinking about the recent sort of ransomware. It's just the fact that people are not buying. Exactly. So, I'm thinking, obviously the US market's the bigger market, but I'm thinking about a couple of examples recently closer to home here in the UK with the Marks & Spencer and the Co-op ransomware attacks. I think Co-op didn't buy at all, and I think Marks & Spencer bought about £100 million or dollar tower. Well, obviously, if you're not buying, you're not covering any of your exposure, and I suspect M&S's losses will be significantly higher. So I think there's still quite a long way to go before we would really consider that market is maturing. I think maybe the ILS market is maturing a little bit more in the sense of, we've seen over the last few years, ILS started out very much as a property cat product, but clearly we've seen investor appetite expand beyond that in recent years, and cyber's one of those. And I think that's great. It's a solution in the marketplace, which clearly our cedents are interested in. We're very interested in the space. We have a cyber product leader based in our Zurich office, Tina Koliznik, who is very plugged in and doing a lot of research. We support. We have quite a narrow client strategy, but we support the market. But I think there is a little bit of a disconnect between what the insurance companies, the insurance players are wanting and probably needing to buy versus what the conventional, traditional rated reinsurance market is offering in a quantity that is enough to make a meaningful difference. So obviously we're all playing in the space, we're all writing quota share, act stop loss, whatever it may be, but it doesn't feel as if the volume is there yet to match the potential demand at the insurance and client end. And there's a few reasons for that, I think. We're still grappling a little bit with the systemic risk, different views on that from different players. The sort of war attribution is a tricky topic. I think the take-up rate, as you mentioned, and I said a couple of examples there. So I think there's a little bit of a way to go. But look, I've thought of cyber as our greatest opportunity and our greatest threat all at the same time for some time. And you have to be in it to learn about it. And we're very committed to learning about it.
So it's a bit chicken and egg as well, isn't it?
It is.
Partly because if you went to one of those risk managers and said, well, look, it's only a sticking plaster. If you could give me a bigger limit, I don't have to think about, if I buy a massive skyscraper, I know I can get it insured, no problem.
Yeah.
The property side of it. Yeah. But with the cyber risk, it's sort of, can you come with something that's actually relevant, and then has the industry got the product and the actual capacity available? Yeah. But it certainly sounds like some of the maturity, certainly around at least getting those ILS structures off the ground.
Absolutely.
Has come through the investment in modelling.
Absolutely.
And so we've become more comfortable as an industry that we can define an event to the extent that we can then build a massive tower around that event, and that we're pretty solid around the foundations of what is in that definition and what is not. Yeah.
I mean, look, I think we welcome any and all tools that help us assess risk across all our product lines, but particularly cyber. I think the whole industry recognises that cyber modelling is very much in its infancy. We're still seeing with property cat modelling, which has been established for far longer, we're still grappling with secondary perils, and are we getting that piece right? So I think there's a long way to go before the industry is going to feel very content relying too much on the sort of modelled outcomes. But look, it's back to data, and it's back to understanding risk and trying to put a price on risk. And I think the market's at a little bit of a crossroads really in sort of trying to figure that out. As I said, the AM Best numbers were quite surprising. I think even just 2 or 3 years ago, the projected exposure and premium for the cyber market was on a very upward trajectory, and it seems to have flattened out. Yeah. And as I understand it, I haven't read the full report, but as I understand it, the exposure is fairly flat and prices come off a little bit. So that exposure flat in cyber surprises me a little bit. I would expect to see that growing. So I think there's obviously growing pains. I think it's a super interesting product. And as I say, I see it as our greatest opportunity, but at the same time, potentially our greatest threat if we don't get our assessment of the systemic risk correct.
We've been talking about AI. What about AI as a global casualty lead?
Oh, my Lord.
The casualty buck stops with you.
Yeah.
So what about AI? Obviously, it's just a massive silent exposure at the moment, isn't it? Because it's not been excluded from anything. It's all in there in liability generally, and professional indemnity somewhere.
Yeah.
It's there if it's not excluded. So is it causing any concern at the moment? There's a few cases here and there, aren't there?
Yeah, I mean, I think the answer is I don't know that it's the top of everybody's. I mean, I think casualty lines have a lot of other things that are high up there causing them concern. Exactly. But look, I mean, I think it would be any casualty underwriter who isn't thinking about it is probably missing a trick and probably a little foolish. I think the question is how will it manifest? And what I mentioned before about the data lineage, I think is going to be very important here. How we control the journey that data goes on and what we do with it and how we use it and where we put it and how we store it, etc. This compliance and governance piece sounds terribly boring to everybody, me included, but I think that will go a long way to alleviating some of the potential threat. But look, it's emerging technology, and honestly, I don't think we have all the answers right now.
Yes, it sounds like the sort of thing we might have some kind of standard. It would be like ISO 9000, whatever it is.
Absolutely.
It'd be one of those things. So if you're not doing that, then you're not insurable.
It's a little bit like data privacy and GDPR. We've learned a lot about that, and there's a lot of compliance and regulation around that. And I think it will be an extension of that in some way, shape or form.
Excellent. One last thing would be looking at that overall, your huge global spread that you're managing. Where are you most excited about growth?
I mean, I think if we look at our portfolio, I think we feel we're probably a little underweight in Continental Europe and APAC. The UK, we've been here a long time. We're pretty established.
I suppose you've been in Zurich for as long as I can remember as well, though.
Yeah, that's true. We have a few competitors in our backyard in the Continental Europe that maybe make that market a little bit more challenging. But no, I think outside of North America and London, I think we're seen as quite a traditional P&C writer. And that is obviously going to be sort of the core of our business. But I think there's a lot of opportunity to access more specialty lines. And as I said, particularly in APAC, perhaps products and structures that are not needed and not bought in the more established and more mature markets. But you have to have the talent on board to access that business, the brokers, the distribution clients. So, we've been investing in that. We've been building out our team in Continental Europe. We've been adding a little bit also in APAC. So I think that's probably where we will see accretive opportunities. Look, the market it's not in a terrible place at all, but the trajectory is in one direction, absent major losses over the next 12 months. So it's really about trying to look for some areas which are perhaps a little less competitively strained. One of the great advantages, I've said it before, for TransRe is that we do have capability to write pretty much any non-life line somewhere in our group. We have that expertise. So it's our job to get it to our teams in the regions and to support their efforts in building out their books. They know this business, they know their clients, and they know the markets, better than we do centrally. So that's going to be quite a lot of our focus, I think, in the next sort of 24 months.
Well, we'll be looking forward to seeing the progress.
Thank you very much.
Louise, thanks so much for your time. It's been really, really refreshing talking to you. You're such a really direct. I've really enjoyed that. It's really refreshing. So thanks so much. And we'll book a time sometime in the future to check in on how things have been going.
That would be great. Always happy to chat.
Thanks very much.
Thank you, Mark.
Well, I hope you enjoyed today's episode. If you did, don't forget to subscribe or leave a like or a review or recommendation on whatever podcast platform you used to access this programme. These really help get the word out. Before we go, just a quick reminder that advertising slots are available here and in other places in the Voice of Insurance podcasts. Podcasting is the fastest growing medium and attracts a high quality audience of key decision makers. It's also an intimate medium where you, the listener, are right in the room with me and the interview subjects. Needless to say, that means it's a great way of getting your message out directly to an audience because you've got their full attention. It's also very cost effective. So get in touch with Mark at thevoiceofinsurance.com to find out how you could be speaking directly to the industry.
The Voice of Insurance is produced in association with Advantage Go. Release your underwriters to underwrite with Advantage Go's underwriting platform.
Voice of Insurance is produced by me, Mark Gagan. Music was written by Anna Gagan and produced by Carlos Gagan. Check out more podcasts and written comment pieces at www.thevoiceofinsurance.com.